You can support this podcast for $3 a month at patreon.com/copytradersclub or find me on eToro, username Gavin Macaulay, and add me to a watch list for future content. Thanks for listening. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin Macaulay, my name and username on eToro. My aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. Here we go. Yes, indeed, Copytraders Club Season 3, Episode 11. And today is a total eToro episode featuring 3 big hitters from the world of eToro copy trading. Friend of the show, Jay Nemesis, makes another welcome return. Jay, how are you?
I'm good. Thanks for having me back again.
And how are things in Basingstoke?
Sunny, for once.
Ben Wood returns for a second time. Welcome, Ben. Anything exciting happening this weekend for you?
Hi, Gav. Thanks for having me on. Nothing so far, apart from this. This is the highlight of the weekend for me. Also sunny over here in King's Lynn in Norfolk.
Well, I'm sure you speak for us all when you say this is the highlight of your weekend. Most exciting thing. And Housewives' favourite, Antonio Nobile, back for the third time. Benvenuto, Tony. Are you in Italy or somewhere in Middle England?
No, I'm in Middle England. I'm in Warwickshire. And we won't tell my wife that I'm the housewife's favourite.
Okay, so as we discussed briefly before hitting record, we're on Streamyard doing our first ever roundtable in video format. So apologies to the listener for the obvious talking over each other, which you've already experienced and will doubtless experience many times more during this chat. And also any interruptions from individuals' internet connections. So it's an exciting new, look at that, it's an exciting new platform, and I can do things like this for the listener. I'm putting little features up on the screen. One says Total eToro episode, J, Ben, Tony, and we have a ticker running across the bottom of the screen. I can also show this, which is the usernames of each of the guests on eToro. So we'll leave that on for the time being as I introduce what we're going to talk about today. So it's divided into 3 parts. Part 1, latest market developments. Part 2, what in the world is going on. And Part 3, old eToro, population dwindlin. So I will introduce part 1 by playing a little bit of music, which takes me slightly too long to find. Okay, so latest market developments. This is where we have a little chat about market-related events. What it all means, recession, no recession, rate cuts, no rate cuts. I suppose to narrow down the conversation to get started, I would ask each of you, starting with Antonio, what recent indicators you've seen that you find convincing in terms of where the market may go? Okay. Antonio.
Let's go. So recent indicators where the market may go. I think the market is right now still sort of stuck in an old regime, as to where, as to the impact of rate cuts. So we're still in this pivot, no pivot, and how much the pivot actually matters in the here and now. So the Fed's taken up rates at the fastest pace ever. And the market sort of thinks that the Fed pausing or maybe cutting rates in the back half is actually going to make a difference. Now we've got a a meeting coming up next week, and I don't know whether they're going to hike or not. I think it's a 50-50 chance. I mean, CME is currently pricing in a 90% probability, but with what's happened this weekend with First Republic, right, and we've had 3 banks blow up in 2 months. So out of the 4 biggest bank blowups in US history, 3 have happened in the last 2 months. So I think there's a good case to be made for the Fed to pause. The question is, what does that, what does all of this mean for the market? And I think the market is currently struggling with figuring out, are we heading into a recession? Are we not heading into a recession? Does it matter? In my opinion, actually whether we do or don't, or how deep it is, may not even matter for the market, okay? Given that we're entering a situation of higher rates. So think about 12 months ago or 18 months ago, the S&P was at 4,800 with rates at 0, infinite QE, right? We're now at 4,200-ish with rates at 5, QT, and credit contracting, okay? Another thing which is useful, I think, and to bear in mind is the supply of money and where that's going, right? M2 has shrunk, is down 4% year over year, which is unprecedented in about 100 years. Last time that happened was in the Great Depression. I wouldn't argue we're going back into a Great Depression. We've got a totally different situation. Probably the recession will be mild. But again, thinking we've got a situation where you've got the highest amount of debt to GDP ever, with money to pay off that debt shrinking. I think another indicator, which is useful, a lot of people have sort of said, question how useful it is these days, is the yield curve, right? The yield curve is deeply inverted. Every time that happens, it tends to lead to a recession. Now, I'm not an expert of the plumbing of the money market, so I'm not going to be able to say whether it's relevant anymore today as much as it was in the past because of sort of central bank intervention. But to me, an inverted yield curve speaks of a bond market which is just telling you future growth and inflation expectations are lower than today, okay? That's what so it tells me of a sort of a sad outlook towards where we're going from the bond market. And the last point I'll make is also on inflation. So inflation's been declining for 12 months. Okay, with money supply negative and the rates high, the likelihood is inflation is going to keep on coming down. But how far down is it going to get? Are we going to get back to 2, or are we going to sort of plateau out at 3-4%? So the base effects, which have helped inflation come down so drastically, are now sort of subsiding a few months after June. Okay, oil, which has come down, really quite dramatically, has now sort of is finding a floor. And you've seen that if it drops a little bit more, OPEC comes in. Okay, we're going to do something about this. So you've got various things which are going to put a floor under how far down it drops. And look, I think the market is still in the hopes of the Fed pivot means we're going to go higher. It's all back to the honky-dory days. At the end of the day, if we frame it on a big sort of, we're at the tail end of a bubble, right? I don't think we can argue. 2020, 2021 was a huge bubble in speculation. I know we're still at the tail end of that, where people are still thinking, okay, Fed cuts, we go back to that, but I don't think we do. Not as quickly as people think. So.
Okay, I think
I'll
I
say
can
that
see
for now, and then if
Jay.
you want, we can talk about it. Yeah, I'll let others talk now.
They're just talking over each other. I think I can see Jay eagerly waiting to jump in on a few of those points.
Yeah, I think some of the things you mentioned near the end are kind of interesting, especially where inflation kind of lands and where rates as a result kind of land as well, and if we do end up back down to the kind of 2% range or not. I think one of the things that I don't think too many people are talking about is how the demographics of the world have kind of changed in the past 5 years or so, and the trajectory that they're now on, which is that outside of Africa and certain areas in Southeast Asia, most populations now have peaked and are now kind of heading into a bit of a decline, and we're kind of getting older populations, less working population being the main thing. And then when you combine that with the advancement of things like ChatGPT and AI, which obviously has been, I think, a bit hyped recently. But I think when you kind of look at all of this, and then you also take a step back and look at what Powell was saying in some of his meetings a few months ago, where he was talking about the supply of labor I think for me, that's the biggest hurdle now that lies in front of us in terms of getting inflation down a bit lower, because the way I see it is that we're entering an environment where the kind of supply and demand for labor and the equality in terms of pay and things is going to continue getting worse. And I think that as a result, prices for goods and services may end up staying a bit more elevated in certain areas. I say that, but it's a bit of a mess. We've seen massive layoffs by the tech sector, in the late half of last year and early this year as well. Kind of seeing what was coming. So yeah, I say all of that, but at the same time, yeah, I'm not sure. So I guess really all I've done here is confirm everything that you said, which is that I think a lot of investors are a bit uncertain about where things are really going to land. Yeah, I don't know. I think you made a lot of good points there. It's yeah. Thunder.
I'll jump back in if I may, to carry on what Jay was saying, which I agree with. It's funny actually. This is the most predicted recession ever, which is not coming. Right? It's this low and slow steamroller coming towards you, and the closer it gets, the more it seems like a mirage because it's taken so long to get here. And I think one of the main factors which has made it so difficult to actually come has actually been the strength of the labor market. Okay, we just come from a situation. If you talk with anybody in the production, manufacturing, or services economy, it's been incredibly difficult to hire people. Right, so employers have this muscle memory of a couple of years where it's been really difficult to get hold of people, and so the moment you see a little bit of weakness, you're not going to lay them off. Okay, and so they're holding on to them. And we're seeing, that's why jobless claims, which have been rising, but they've been rising really slowly. And in Europe, they've actually not even been rising very much at all. Okay, there have been layoffs, but they've been way up on the top end. And those don't show up in the data, because if you're making 200, 250 grand at Google or whatever, you're not going to go and file for unemployment claims. But on the lower end of the spectrum, there's demand for labor and there's a labor shortage, and a labor shortage is not going to get solved immediately. And labor now, for the first time in maybe 30 years, has bargaining power. Okay, and I think that's a huge, huge change. And this is a really big sort of, and it's not going to get solved immediately. But labor is demanding higher wages, which is going to reduce margins of companies. We've seen that in recent earnings. Margins are coming down, and I think that's a trend which is going to carry on for a number of years. And it ties into an inequality discussion, which has other ramifications, I think, for inflation. But I'll pass the ball on, and then maybe we can talk about that later.
Okay, maybe we could hear from Ben. I know you're sort of more towards the long-term value investing side of things, and perhaps a little bit more agnostic to short-term market movements. Mm-hmm. But no doubt you have some views on where we are and where we might be going.
Absolutely. Yeah, I mean, it's all interesting points, and it feels like, I like the analogy of the steamroller of a recession that's coming over the horizon. I mean, it's like we've been flirting with it for a long time, haven't we? And everyone, recession is obviously inevitable at some point. But it's just what form that's going to take. I mean, they all look different, don't they? And I think actually looking at the labour market is quite interesting, because I think we shouldn't forget that there's still actually a hangover from the sort of 2008. If you look at public sector employment, it's a whole different ballgame to private sector. So like the tech layoffs, arguably, I mean, I sort of in a way come from a tech background, software development and product management. And I think what I saw coming through sort of COVID era was actually that the employment was off the scale anyway, and salaries were off the scale, and that was always going to come back down. And that's probably sort of a weird effect of COVID, in my opinion. And that sort of weird sort of surge in the tech sort of sector. So I think that's just really a correction from my point of view. I think what's more interesting is the public sector, because I mean I've previously worked in the public sector for a long time, and coming out of austerity sort of 2008 onwards, it's never really recovered from that. So it's going to be interesting to see what's going to happen with things like unions and pay deals over the next few years, or even the next few months. So I think that's going to have quite a strong impact on what happens, and then whether that has some influence, what government's going to come in next. So if we get a Labour government, that's going to be quite interesting. from that perspective as well, and what pay deals are going to get signed off for the public sector, because I think that's going to have a huge impact, and obviously links back into things like inflation. And the other thing we haven't really talked about is something that I'm particularly interested in. I'm kind of holding off on at the moment, is sort of real estate and the housing market, so both commercial and residential. So obviously what we're going to be seeing over the next couple of years, and I'm in the same boat myself, is like people renegotiating deals on their mortgages for their houses, right? So against this background of inflation and higher costs, and no one's quite sure what's happening with salaries, again, particularly in the public sector, we're going to come to a crunch where household incomes are so squeezed. I mean, we're already talking about cost of living crisis, but what's going to happen? Obviously, I have a UK bias, and UK is strongly, I would say, dominated, but the housing market is a big factor in the UK economy. It always has been, I think. What's going to happen there? So we had like 10 plus years of very, very low interest rates, which is super unusual, and people just kind of got used to it. And I think now it's that kind of, it's the cold shower time. People are going to wake up to that fact, and I'm not quite sure we know how to actually deal with that. And then also staying on the sort of real estate side of things, which is a part of the market I'm particularly interested in. As I said, I was previously holding quite a bit of sort of commercial real estate and things through various REITs. Dropped all of those for the time being, because commercial real estate is really looking very confusing at the moment. So, what's happening on the high street, what's happening with things like warehouse space, but also particularly, office space. So are we going to see gradually a return to normal in terms of how people actually work and how companies operate their offices, for example? I mean, yeah, as you said, Gav, I'm kind of long-term on all this stuff anyway. I'm quite stoical. I think gradually that will all settle down. So we're seeing problems with like maybe sort of what we might say subprime office space at the minute coming up to try and renegotiate finance on, low grade offices or even reasonable grade offices that are struggling. And you see the high grade offices probably doing fine because everyone's cutting down their office space but going for the better properties. Are we going to have a crunch there? I mean, people are talking about this. It's a particular area I'm interested in as well. So we're going to get a double real estate crunch on residential and commercial. And I think that will have a kind of feedback loop into the UK economy, which could, in my opinion, that might be the trigger for recession. But let's see. We'll see.
Mm-hmm. Well, that's interesting. Well, that's a good UK perspective, certainly. If we could sort of move back, I think, just to the US for a second. Antonio tends to skew bearish, it's fair to say, these days. Jay, I think, wants to be bullish, but
I want it so badly.
Isn't being allowed to be, or he won't allow himself to be as bullish as he might naturally want to be. What I want to talk about is whether you think we're sort of running up to something like a cliff edge, or the theory, on the other hand, that the market is absorbing all this bad news and kind of pricing it in a piecemeal fashion, absorbing all the little jabs here and there and holding up quite well. The economy's sort of absorbing these blows and is unlikely to be KO'd in a dramatic fashion, because it's sort of taking the punches as it's going along. So it's a bit more of a drift downwards into a recession. If the recession's not been dated, maybe it's already happened to some extent. So which of it is it, or is it somewhere in between? Are we looking at a cliff edge or a beginner ski slope in terms of economic decline and market response, really?
I guess I'll answer that one. I think we're on a bit of a bumpy road, to be honest, and I think really a lot of this comes down to geography and also local politics to a large extent. I think actually that was highlighted a lot by what we were saying just now about the markets in the UK and the property markets in the UK, and the way that that's kind of looking here, and then you kind of contrast that with the US somewhat. There are some similarities, of course, but in the US, you've obviously got a very different situation with mortgages and interest rates and things, because the length of term that they secure on their mortgages is so much longer for properties. And so, that alone makes it a massive difference between the UK and the US. And then again, you can do the same kind of contrast with China, where I think industrial properties are the things that are now starting to that the part of that market that's starting to struggle a lot as well. And we've obviously seen the housing sector there struggle a lot in recent years too. And obviously that's just property. If you then look at it beyond that, and you look at the kind of what really builds the foundation of the economies in all of these different countries, it's so different. Where some countries are incredibly reliant on things like tourism, some are reliant on raw materials. You've got obviously service-based economies and software kind of based economies. I think all of that kind of means that the world is such a kind of bumpy place now with what's going on. And really, I think you're kind of right. I think the market has got shock absorbers. When you look at the fact that we have had those massive banks go down, Silicon Valley, I think was really, I think, the thing that highlighted it. The market got very nervous very quickly, and then within days, everything seemed fine. Like over the course of a weekend, really an awful lot changed. And I think we're still kind of continuing to see that. So really, for me, I think the danger of it getting worse and it turning into a bit more of a cliff is actually reliant more on government policy and bad monetary policy. I think that's the thing that would actually turn it into more of a cliff. But I think at the moment it's really just looking like a slightly bumpy downhill. And I think there's even some debate, depending on geography and somewhat even just luck, whether it really even will be a downhill or if we've just kind of plateaued for now. It's a strange environment to be investing through. But the one thing that I will say as my final point, I think, is if you stop and you kind of take a step back and then you look at earnings, I think aside from kind of service sectors, generally they're pretty okay. They're not necessarily outpacing inflation everywhere, but I think that they're keeping up and holding up relatively well overall, especially, we've seen with a lot of the big tech earnings recently that they're still surprisingly strong. And I think that caught quite a few people off guard who are expecting a bit more weakness in those kind of sectors.
Okay, well, before I pass it over to Antonio for his closing thoughts on this, a lot of people do talk about this being, well, I've heard the term millennial earnings season, as in everyone gets a trophy. They've been revised downward so much that beating them is really nothing to write home about. I wonder, maybe Antonio, you can incorporate that into your thoughts as we close out this section.
Sure. So earnings were okay, but they weren't great. Okay, so as you say, you set estimates low, you beat them quite handily. Another thing which I think people don't do, and we haven't had to do for about 15 years, is adjust earnings for inflation. Okay, because you've had inflation at 2%, so you don't have to adjust them. But we've had inflation on average about 5-6%. Okay, high low, now it's about 5%. Adjust earnings to that, and earnings are a lot lower. Okay, and the other thing is, some of these mega cap techs, and this is really important. So from a structure of the market perspective, if you remove the mega caps, Apple, Microsoft, Google, Meta, from the indices, okay, Apple today is 7% of the index. Microsoft's about 7%, so they're 13% of the S&P. When you take an ETF like XLK, they're 50%. Okay, Microsoft and Apple are 50% of the XLK, just two stocks. Remove those, and the equity markets are actually a lot lower. And their earnings of these companies, we'll see Apple in a few days, but take Google, I think their earnings were up 2% year over year. Okay, just after inflation, they're down. Okay, and these companies are still priced with a growth multiple as though they're growing at a rate which they're not growing anymore. And you want to ask yourself, how long is it going to be before they start growing at that rate again? Are they going to grow at that rate again? Market leadership changes, right? You have cycles, whereby we've just gone through a huge tech cycle. I wouldn't expect Apple to be the biggest company in the world forever. Maybe that lasts for, I don't know how many more years, but at some point that's going to change. It'll be a different sector. We don't know. I'm not going to speculate on what. So I think when you look at the market and you look at the indices and you look, everything's okay. The reality is it isn't. If you look underneath the hood, there's been absolute carnage in a whole load of sectors. Okay. But the indices have held up. They've held up because of these mega caps within them. And again, it goes back to what I was saying at the beginning. It's a bubble. Okay, people are investing in these. They keep on investing. It's always going to be the same. Then there's a whole lot of passive flows which constantly are going in and which are supporting the market. Okay, retail is still buying. Retail is still involved in a very heavy way. You open CNBC and everything's still fine. I think the market, and the irony is everybody sees a recession, and everybody's in a way. You've also got a lot of people who are positioned for it, which creates the other side, which balances it, right? And so you've got this push and pull, which we've seen for about 12 months. The market's gone nowhere. Okay, it's hovered in this range, and so I would suspect at some point we trade lower. There is going to be something which triggers how quickly that happens. I think it's not so far away, maybe. But the other thing is there's been this dynamic in the option world where volatility is being compressed because of how. And again, I'm not going to pretend to be an expert on this, but the amount of volume which occurs in option markets is about 50%. Okay, and of that 50% of the whole option volume is 0 day to expiration options. Okay, and a lot of those, and you can actually track these through pretty simple websites. You see, it's all calls. You go in and there's hundreds of thousands of calls which are being bought for like pennies because they expire on the day, which are helping provide these flows. It's gambling at the end of the day. It's the dealers who are making the money on this. It's the house that makes the money. But those flows, in a way, I think, are also providing are proving to be supportive for the market. You see the market which moves within these OPEC cycles, right? And either starts to sell off at the beginning from one monthly expiration to the other, or then it trends higher, and then you start once the next monthly cycle gets going, and it either sort of the ball gets rolling or it doesn't. And so you've got a whole load of microstructure things going on within the market. But again, we're now at 5% rates, so there is an alternative. If the market keeps on fucking around, people have the option to go and park money at 5% without risk, without headache. And I think that is also something which people don't think about, but you have an option now. And again, it takes time. Mentalities, you have to, it takes time to change them psychologically. But again, that's just another thing. So eventually the markets will find a decline, whether that's, when that is sort of speculative play.
Okay, well, you mentioned CNBC there, and of course, Jim Cramer has confirmed that First Republic marks the end of the banking crisis. So at least we've nothing to worry about there then.
Yeah, indeed.
Okay, so that'll do us for part one. Coming up in part two, what in the world is going on?
Do you copy?
Do you copy?
Do you copy?
Do you copy? Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Okay, so part two, what in the world is going on? We're going to just discuss a little bit geopolitics, what's going on in the world, the end of the American Empire, Ukraine, tensions over Taiwan, Russian pranksters talking to Jerome Powell. I'm sure you saw that. What does it all mean for us, for our investing decisions in the years ahead? This is not latest market developments. This is more the sort of wider view. What in the world is going on? So let's go over to our resident geopolitics expert, Jay. You can kick us off with this.
I wouldn't describe myself as an expert, more of an armchair expert, maybe. Wow, yeah. I guess it's a pretty big question these days, isn't it? Which I think highlights, how much things have changed. If you rewind 10 years or even 5 years, really everything seemed pretty fine. The US was having its kind of Cold War trade war with China, a lot of tit for tat, and aside from that, really, there were a few kind of proxy wars between Russia and the West, and that was it. And then you look now, and all of that has kind of ignited. Really started by obviously what's happening in Ukraine, which we're now over a year into. I think there's markets have really kind of recovered from the original impact of a lot of what was going on in Ukraine and Russia. They've kind of stabilized, especially the food prices and the prices for some of the kind of big commodities that come out of Russia or Ukraine. So a lot of the different, obviously oil and gas, but then you've also got a lot of minerals and things that come from those regions as well. Things like iron, very, very concentrated in those regions. So I think, markets have kind of adapted to that pretty quickly, actually, faster than I think a lot of people thought they would. Obviously, there was a very sharp drop at the beginning, but really, I think when you look at how especially the food market, I think is the one that's the most surprising to people, how well that's recovered. That being said, I think we are seeing warning signs in a lot of regions, actually, of conflicts getting worse. We've just seen the kind of conflict erupting in Sudan. Libya is still going through its civil war, which again has got backing from different countries and different sides, even EU countries backing different sides of that war, which is very, very strange. I think things in Azerbaijan and nearby Armenia, obviously, and then you've got Georgia in that region as well, and obviously the big Russian influence over that area. That's still kind of simmering over there as well, pretty badly. We've got the situation with Ethiopia and Egypt. Egypt is arming up massively. There is really so much going on at the moment in the world, and that's not, of course, to mention the big looming threat of what will China eventually do, or will they just continue really not to do that much and just kind of posture? I think really when you look at investing, I think from a risk perspective these days, I don't think geopolitics has been as important as it is now for quite a long time. I think there's always this kind of tendency, I'm going to kind of backtrack from that a little bit and say there's this tendency to always think that the sky is falling. People always seem to think that there's more war and there's more famine and more disasters than at any point prior in history, when in fact the reverse is true. But we are definitely at a bit of a spike at the moment. And I think, investors have become more and more aware of that as they've kind of got caught out in, especially what was going on with Ukraine. A lot of people were caught out by that. A lot of people then tried to play that very quickly and tried to, buy into Russian companies or buy into Ukrainian companies and things, hoping that, the war would kind of resolve itself quite quickly. We've just not seen that happen. So, I think it's just a case of, goods kind of diversification across geographies is more important than ever. As for the US, are they? Is the US kind of dollar under threat and all of these kind of things that people have been talking about recently? I don't think so, really, at the moment. I think it's a bit too far for me. I kind of need to get the tinfoil hat out a bit to push it quite that far. But I do think that there's certainly more risk associated with that than there was before.
Okay, Ben, do you want to join in here and talk about how that influences maybe your thoughts on a long-term basis?
Yeah, absolutely. I think it's interesting points there from Jay. Well observed. Like the short-term shocks in things like food supply, it has been interesting to see how relatively resilient those systems actually are in practice. And I think another good point that I would wholeheartedly agree with is basically the principles of investing don't change in these circumstances. You just have to think about diversification, whatever that means, across sectors, across categories and geographies as well. Obviously, as you know, I'm more on the long-term end of things. So that's always been my position, really. Reasonable diversification and trying to keep a level head, because I think as well, the media plays a big role in this. It's always been sort of my point of view that on average, we're living in probably the most stable, most prosperous times. Obviously, at any particular point in time, it might be a particularly bad moment, but on average, things are perhaps not as bad as the media would have you believe. So I'm kind of in that camp as well. and that people just need to keep their heads. I mean, obviously there is a subset of whether you call them investors or not, who are trying to play this, as Jay points out, and are trying to trade off against different scenarios. I'm certainly not in that camp and have no particular knowledge in that area, so I would stay clear from that. The things I'm interested in is more like the super long term, what's actually going to happen with all this stuff. And I think that the two big things really, in my mind, are obviously the energy question is huge, and it is that's a multi-decadal issue that's going to have to be resolved gradually over time. And cutting across that is the whole environment, climate change agenda. And feeding into that as well, the other big one I'd probably mention is natural resources. So things like critical minerals is huge. I mean, I come from a geoscience background, and I've been around this kind of stuff for 20 odd years. I think we've become complacent in that whole area, and that we just think that we're going to be able to get hold of those things forevermore from wherever we need to in the globe. And obviously, Jay alluded to it, that the distributions of some of those resources are very particular. And, a lot of them are in places like China and places like Russia, and that's inescapable. That is as literal as geography as you can get. You can't get those things anywhere else on any kind of meaningful scale. I mean, I saw a report the other day that actually the UK is looking at its own critical minerals resources, and it's a bit like what we did with fracking sort of 10 or so years ago. It's just theatre. We're not going to be digging up the landscape to get critical minerals out for magnets and batteries and bits and pieces from the UK. We're just not. So we're going to have to resolve that somehow. Those things are going to have to come from somewhere, and I think that they sort of long term, with the geopolitical sort of background, in terms of what's going to affect investing and economies and so on and so forth, I think it is those big things. Where is the energy going to come from? Because obviously energy underpins everything we do. It underpins industry and food production, et cetera, et cetera. How is that going to play up against the climate agenda at the minute? And then the energy transition, so that the whole clean energy thing is interesting there, because that is absolutely geared to the availability of things like critical minerals, and the ability to process them, and the ability to have supply chains for those things. So anything from your EVs that are becoming sort of gradually more popular, but there's a whole other set of things, wind turbines, huge magnets that go into those. It's things that I think most people don't really think about day to day. They're going to be looking at their gas and electric bills, but they're not going to be thinking about, actually, there's a load of stuff we need to get hold of from around the world to make this energy transition work. So in terms of, I don't really like to predict things, but I think what we're basically going to see is a bit of a slowdown on that in the macro. So all the sort of climate targets and things like that, I think they're just going to get kicked down the road a bit, and I think that's going to have an interesting ripple effect back through the economy. We're going to have to, I think, short-term resilience we've done okay with. I think we're going to have to sit and watch what's going to happen sort of in the long term with all that stuff, because although we've absorbed some of those shocks in the short term, I'm not sure how well set we are in the long term. So if the whole China situation comes into play, obviously what Russia did with oil and so on in the last year or so gives you a little bit of a clue to the sorts of things that could happen for other sorts of resources in the future, and they have a massive impact on everything. And I think some of that pinch will be felt down at the consumer level as well, and that's when it's going to start to get really interesting. So I think we had a little glimmer of that even during COVID, when supply chains for certain things like consumer electronics became slightly difficult. And we saw what happened there, sort of panic buying and bits and pieces going on. I think we're gonna be living now in a generation where that's going to be just the norm. There's going to be constant supply chain interruptions. There's going to be posturing on a global scale around the availability of natural resources. That's probably my take on it.
Very good. Antonio, you're, I believe, more inclined to invest with these kind of changes in the worldwide picture, macro economies. What's your take on this?
All the times they're changing.
As ever.
I think Ben and Jay make some very good points. And I would say the key takeaway from the points that both of them make is that we're entering a period of higher volatility. Okay, we've come from a period of stability and trending calmness, or volatility trending downwards, to a period where volatility is going to trend higher and it's going to pop up in different areas for different reasons. And from an investing point of view, what does that mean? It means that maybe the strategy which everybody's been using for about 30 years of just invested in the indices won't work anymore, and you have to be able to find the sectors and the companies which will be able to perform, or which will, because of a supply shock or because of government pouring money into a sector or whatever, will outperform other sectors. But if I can take us a step back and look at this a really big picture, I think and highlight probably one of the other issues of our time, which I think is here now, and is going to continue to be here, which is inequality. We live in, it's true. We live in, we have fantastic services, availability of a whole load of things today. We live a great life, but at the same time, we can't compare today or yesterday to today based on today's standards, right? You have to do it on a relative basis. And on a relative basis, today inequality is at heights which it has not been at for years. Okay. Now we can look at why. There's a whole lot of reasons why. But I think the key point is there's now anger and resentment towards that inequality. Okay. There is a demand from the people to resolve that. And what does that mean? And so to me, it means that we've gone from a period where, I go back to what we were saying at the start, interest rates and inflation. Okay. We've gone from a period where interest rates and inflation have moved from the high teens down to zero over 40 years. And what does that mean? Interest rates come down, asset prices go up. Okay, it's an inverse relationship. You plot the same graph is the amount of wealth of the minority compared to the amount of wealth which belongs to the majority. Okay, because the asset wealthy and the asset poor. Okay, you could plot the same exact picture, which is margins, okay, the company margins compared to the pay of workers relative to that company margin. And again, you see that margins are at the highest and worker compensation compared to those margins are at the lows. Okay, now there's a number of forces which have driven that. And I think that those forces are now all slamming into reverse. Okay, of course, you've had one of them has been, people always point at the Fed and blame the central bankers. I'm not entirely in that camp, in the sense that, yes, there's been a change in policy from Volcker to Bernanke. Okay, it's a complete reversal, 180, complete 180 in terms of Fed thinking. But what was driving that? And I think there were some bigger forces which were pushing in that direction anyway. So whether you'd have had Greenspan, Bernanke, or Yellen, or somebody else, I think you'd have gone towards low to zero rates anyway, because inflation was coming down due to a number of reasons, but be it the China entering the global economy, so cheap labor, okay, that's now reversing. But what does all of this what did China coming into the global economy and all of that cheap labor mean? Inequality is even greater in China than it is here. Where was all of that money going in China? Was it going to the Chinese workers and raising their standard? To a degree, but not very much. Okay, most of that was then being recycled into US assets, into treasury bonds, etc., which pushed yields lower. So you had that capital flow pushing yields lower. Okay, as yields come down, you had investment in tech which soared. Okay, you could speculate further and further out on the risk curve because money was cheaper and cheaper, which led to a tech revolution, which was deflationary. So you've had all of and then all of that came with globalization, right? Because the bigger these tech companies got, okay, the cheaper, the lower rates were, the bigger they could get, because they could acquire other companies get a loan for 0% and acquire another company. Okay, that's how Facebook got this big. That's how Amazon got this big. You just boom, boom, you get bigger and bigger and bigger. And so that again pushed was a force in favor of globalization. And so I think now we're entering into a world where the people are sort of saying, hang on a second, you got to think about me now, because look at these house prices, I can't afford a house. I open Instagram and I see all these billionaires. It's always the same 10 or 20, but here's me. Yeah, I've got an iPhone. Yes, I've got running water, all that kind of stuff. But so the people are sort of pissed. And we saw that. We saw that with Brexit. We saw that with Trump. You saw that with the 5-star movement in Italy. You saw that with Tsipras and Varoufakis in Greece and all of these kind of things. And I think we're now in a situation where there's just going to be demand from the people to sort of think about them a little bit more. And that's what was one of the greatest greatest things we've learned from the response to COVID. We did fiscal as opposed to monetary easing for the first time in a big way, giving people money. Okay, and that was inflationary. And so if we keep on having these policies, it will continue to be inflationary, which means interest rates, as opposed to I'm going to go way out there and make a crazy bold call. But I'll say I think there's a high chance, and obviously there's always risky saying something like this, that we don't see interest rates at zero again for a long time. Okay, I think there's a chance that we don't even see them again in our lifetimes. Okay, because it's a failed experiment, and I think that that's something which even is being acknowledged even inside the central banks because of the distortions that it creates. Yes, it's good on one end, but it creates a huge amount of distortions on the other. So it doesn't mean we're going to go to 10. It means that we'll hover around 4. Okay, and maybe we'll hover around 4, and they'll drop down to 2, and then they'll be raised to 6, and maybe we'll hover in this area. And that's a totally different investing landscape than the one we've been in. And so I think this is probably one of the key things to bear in mind. And again, what politicians does this kind of policy? And this goes back to what you guys were saying, right? What Jay was saying about wars, or what Ben was saying about green policy and all that kind of things. So who do people vote in? What do those policies then mean for the investing landscape? So I think again, the key takeaway is a world of higher volatility as opposed to a world which is trending towards ever greater stability and globalization. Is sort of inversing.
Well, fantastic. Very interesting thoughts there from all three of you. Thank you very much for those contributions. That was part 2. Coming up in part 3, old eToro, population dwindling. So part 3, we're just going to talk a little bit about what's going on in eToro. How little engagement are any of you seeing on the platform? It's fair to say eToro has crests and troughs of activity in the same way as the market does. More people are interested when things are going really well. And I wonder about, how can we place that in its historical context? Those natural ebbs and flows, or what other things are happening? We could factor in the good news that we heard recently. Well, we can debate whether it's good news, but it certainly appears to be, which is the Twitter deal with eToro. So I wonder, will we ever get back to the booming days when certain PIs laid career foundations? Is that possible? Are those days ever going to return? Let's go to Ben to start this conversation off. Ben, are you seeing plenty of signs that the platform's not really a hive of activity at the moment?
Yeah, it's an interesting question. In terms of me responding to that, I'm relatively, I'm pretty low key on eToro, to be fair, and I think I'm probably on the low end of the spectrum in terms of general engagement anyway. So my outlook is super long term, kind of slow and steady. So I'm not necessarily on there every day looking for people to interact with me. I'm just doing my own thing, kind of stuff, and then posting updates as and when necessary. I'm not sure quite how I feel about this. I think in terms of engagement, I think it's a macro thing. I don't think it's necessarily, from my perspective, particularly to do with eToro as a platform. I don't think that's the issue. I think it's people have just lost their taste for this kind of stuff. Basically, that's what I see. I mean, away from eToro and the people I talk to, obviously, it's a skewed sample and it's a small sample of people I talk to. But if I go back to sort of COVID times when people were just going crazy over all this stuff, and including stuff like crypto as well, which is a different sort of category for me from my perspective. I think what we're seeing here is a macro trend that people have just lost their taste for it. I think it was a little bit of a bubble in that sense. So I mean, I personally still really like eToro as a platform, both as a PI, which is, to be fair, not something I set out to do on eToro at all. It's just something that became obvious that I ought to give it a try at some point, but it's not why I came to the platform in the first place. And I think I still like it as a platform. It's still where I've got a significant amount of my assets sitting on the platform. And I intend to continue to do so. And there's various personal reasons for that. But yeah, my take on this is very much the macro. I think that people have just. It was a weird blip, I think, like the last sort of 2.5, even 3 years, that people were getting into the idea that they might actually start doing investing themselves, or trading, or a bit of both, whatever you want to call it. And I think the whole crypto thing helped massively with that as well. So that drew people into it, who then probably diversified out into other more traditional sorts of equities. And yeah, I don't think I don't imagine that we'll see a return to that for a very long time. I think there's people who, I mean, the large majority of people who I talk to about investing as individuals still see it basically as gambling. So I think it still has a bit of an image problem. And then when you see what's happened to people, so some people who've gone in quite naive and have gone like maybe they've gone heavy into like crypto or something without really thinking too hard about it, and lost a lot of money over the last year or so. I think there's going to be a hangover from that, and I think it's going to take a long time before those people come back around to the idea of investing again as individuals. And I think it's a real shame, actually, that because I really like that movement, that people could do their own stuff, because I don't think there's I'm sort of a child of grew up in the 80s when the idea of stocks and shares and investing, it was all very glamorous and all very kind of abstract and something that other people did. And I really liked it when individuals started to realize that they could do that kind of stuff, and all these platforms emerged. And I still think eToro is the best one. So I think it's a shame that it sort of popped with it. I think it just formed a bit of a bubble and popped. And I think so there'll be a significant proportion of people, demographically speaking, who have probably been put off investing for life at this point, which is a real shame. So yeah, I mean, in terms of engagement and stuff, I mean, I'm not someone who's on eToro every day engaging with people. So it's, I'm probably a bit of a skewed sample in that respect. So yeah, as I say, summarize, I think this is a macro issue, and I think there's a lot of people who will never come back to investing on an individual level, or they will be taking a break from it for a significant period of time. And I think that will have an effect on the platform. In terms of eToro's strategy, I mean, I'm not quite sure what that is at the moment. Obviously, the platform is shifting, and like, from week to week, you'll go on it and you'll see that they're reordering things and putting different types of things to the fore. And I think, the copy trading thing seems to have been slightly reduced in terms of its prominence if you just log on these days. So yeah, I mean, I don't have any real clarity of thought on that at this point. I think it's a general thing. People have just lost the taste for it.
Okay, so a unique bubble, or a bubble within a sort of still secular growing trend? Jay, you're probably best placed to put this in its historical context.
Yeah, well, I actually think this bleeds into a lot of the points that Antonio raised over the last couple of topics, in fact. So I think it was in the first topic where he mentioned the weightings that we have in indices, and essentially alluded to the fact that we're moving into more of a stock pickers market now because of the way that interest rates are and everything, and people need to really start factoring that into their valuations of companies more. And I think that actually is what will be the saving kind of the thing that saves eToro's copy trading. I say saves it. I don't think it's dying by any stretch of the imagination, right? But I think it's as Ben mentioned, I think there's a lot of investors that have kind of been scared off. I think also in this kind of environment now where you can just go to your bank and potentially get a 3, 4, 5% yielding account, people are kind of turning away from investing a little bit now. But I think the fact that we have been in this kind of mindset of index investing for the past 20 years or so now, certainly the past 10, I think that that's really coming to an end now because of that same environment, and because it's becoming more of a stock pickers market. Really, it's the time where popular investors can shine, I think, and kind of demonstrate their returns much more clearly. I think that it should become easier to outperform markets if you're good at finding valuable stocks. So yeah, and that's always something that really ebbs and flows in markets anyway. I think that there's always this kind of push and pull in that way, and the same is true of politics, right? You see the kind of flow from left to right and left to right over time, and also linked to that again with something else that was discussed earlier is the kind of concept of the power that Labour now has to negotiate, which again Antonio alluded to. So I think on that front, where we're seeing, and this even ties into natural resources, it's kind of weird to be honest. It's like it ties into everything we've spoken about, but where Ben was talking about natural resources and kind of the security around that around the world, we're seeing more and more governments kind of turning kind of insular and looking to become more self-reliant and self-dependent. And I think it was Chile or Bolivia recently that was talking about nationalizing their lithium mining. I think it was Chile. And things like that really, I think, are going to make a massive impact as well. You're going to be in this environment where you have investors from different regions that are more specialized in their knowledge than it's really possible for large funds to be. So I actually think that there's a really good opportunity for people to kind of take advantage of that, of their specialization, and kind of understanding their corner of the market more than anyone else really can. So yeah, I think that will bring more people back onto eToro as those results start to come through from more and more investors taking advantage of that environment. The other final thing I'd mention is, I guess, the growth markets, right? I think it's quite easy for us in Europe and the US to kind of look at the world and say, everyone's online and investing now, but there are still so many people in India and China and areas of Southeast Asia, sub-Saharan Africa that still have no real market access, and those markets are still being developed and kind of being linked in to the global kind of system, as it were. And I think that we're going to see opportunities there kind of grow for eToro to bring in new users from those regions. And it wouldn't surprise me too much to see eToro kind of start to focus on that in the coming years. I know that countries like the Philippines have been massive for eToro. So I think when you look at countries like Thailand and Vietnam, for example, those kind of regions, I think there's a pretty big opportunity there, pending regulatory environments and everything else, of course.
Yeah, Philippines is number 2, isn't it, in terms of your copiers? Or it was
it was for a very long time. Yeah, which staggered me the first time I saw it. When I was at my peak number of copiers.
Where do you check those stats?
So you can access it via eToro's API dashboard thing that they've got. I can send you a link afterwards if you like. Yeah.
Okay, over to you, Antonio.
I mean, look, I get a lot of engagement in my personal post weekly. Once a week, I try and post every Monday, and so engagement is still strong on my feed. It always amazes me, some of the discussions which go on and some of the details that some of the people on eToro and some of the copiers go into, not only looking into your strategy, but also looking into, the markets and all this kind of thing. So I think I always find that impressive. But I do think what what Ben and Jane were saying, it's true that we've gone through a bubble, and of course, it attracts investors, and when that bubble pops, investors become disassociated, and that's normal. There's been this idea that investing was easy and anybody could do it. You just have to buy and hold, and we'd all hold the same things, and it'll all be fine. And that idea is slowly dying, and so the realization that it's not as easy as people thought is setting in, which, as Jay says, could be a good thing for PIs with able to navigate sort of the complicated times which we're in, or we're going to be heading into. I think on a broader perspective, I think it's really interesting because we've gone through an era of financialization in a huge way, bringing a whole load of people sort of to online, investing online, or online banking, mobile banking, crypto, all these kind of things. And I think it's going to be a trend which is going to be really, really hard to stop. The question is, where does it go? And I'm not going to try and speculate on where it goes. Like, does it mean we're all buying Bitcoin again, or speculating on crypto again in the future, or is there going to be other things which we don't know today, which are going to come up, right? I think that's definitely a question. But the idea of financializing assets, the cat's out of the bag. I don't see how that sort of slams into reverse. And the other thing which I think will be interesting is, is the impact of AI, and I have no idea. So somebody who's looked into this more than I have can maybe illuminate us. But a friend of mine sent me a link just yesterday with FinGPT or Finance GPT or something like that, which is like an auto GPT for fine. And the example, at the moment you open it, there's an example of you asking it, can you summarize Microsoft's Q2 earnings for me? Something like that. And so I do think that's for maybe analysts and things doing that kind of job. I think that just cuts out a whole load of analyst jobs, right? But if you have, I don't think we're in a situation where AI is going to be able to invest for you yet, other than doing, the obvious recommendations which bank does. Of course, you can automate that. The banks, they have a number of, select products that they recommend in different environments, and of course, an AI can do that. But doing the job of what a PI does, or what a fund manager does, or what an investor does, I don't see how AI can, as of yet, figure out the psychological side of the market. And as much as we've talked about passive flows, and as much as we talked about market positioning and microstructure and whatever, there's still a huge psychological part to the market. And I remember when ChatGPT first came out, one of the things which I found most interesting was all these people on Twitter figuring out how to trick ChatGPT to do things it wasn't supposed to do, right? And I thought, if there's anything that this proves is the level of human ingenuity and human creativity. And so, but I think we're in interesting times. And I think eToro is still doing really strongly as a platform. I look forward to seeing where we go. I'll end on that note.
Well, fantastic. Thank you very much, Antonio, for that. And listen, we've gone over the hour, so should just wrap it up now. I hope the technology we're using, and particularly my internet connection, has held up, and that people were able to enjoy your contributions, everyone, throughout that chat without any great disturbance. So with that, I will say thank you very much to all of you guys for being here. Hope you enjoyed it. How do you think it went? Did you notice any technical woes?
All seem fine from my point of view.
Yeah.
Pretty sure I disappeared a couple of times. I had lots of swirling circles. Okay, gentlemen, thank you very much. And until we meet again at Copytraders Club, best luck. I'm just trying to fill in until I can find the... Oh, this is a disaster. Trying to find the closing credits.
You've saved
which
me, yeah?
are coming up now. Goodbye, everyone. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit chat. We don't know your individual circumstances, etc., and so forth.